know since we're starting so late.
Yeah.
So was that 3 years? Was that, did you get out early or was
I
that?
got out early. Good behavior.
So the actual sentence was more like 10
It was,
to
it was,
Yes.
it was COVID release.
Yes.
Something I'm proud of. Well, it's a pleasure to be here today. It's like when I used to do these things a lot, there was always the big question was you don't want to be the first one after lunch, right? So, because that's the tough crowd. And we're having some technology issues, so let's see if this works. What I want to do today is, so my long story short is, yeah, to John's point, I was, those of you who are familiar with the old Connecticut General program in the life insurance industry, it became Cigna, then it became SageMark. So it was us and Northwestern Mutual and Mass Mutual back in the day. My dad was a CG guy back in the 70s in Detroit. And I bring it up because, like, I've been in this industry since 90, well, I was with Ernst & Young on the tax side as the CPA for 2 years, realized that conformity was not my thing. So I flipped into financial services, and I've been in the space ever since with a whole kind of Grateful Dead long strange trip. Well, it's been kind of deal. And it found me 10 years into my practice, getting introduced to Julian. And Julian is kind of viewed as the founder of traditional commercial life insurance premium finance. And I met up with Julian in early 2000s, and we used to call ourselves the M&M Show, bipolar opposite personalities. He was funny on stage and entertaining, and I was that kind of the CPA mentality that came in and put some substance behind what most folks who have seen a premium finance ledger would probably agree can be overwhelming, lots of columns, lots of rows, and then when you kind of focus in on the illustrated results, what did my mom tell me? If it looks too good to be true, it probably is. There's no such thing as a free lunch. All the things that come into play with how the economics can look initially and how that can translate into a very difficult sale. And I spent about 10 years with Julian trying to convince him in a very positive way that there was an approach that I felt from a CPA's perspective could be woven into a story-driven representation of what's really going on with life insurance premium finance. And what I found is that over the years, like anything, we tend, as human nature, as creatures of human nature, we tend to revert to what instinctively we think is the right thing to do. And what I've found through the School of Hard Knocks is that that's not necessarily the case with life insurance premium finance. So it becomes a matter of perspective, like anything in life. If we kind of jump in here, let me see if I can work this guy. Yeah, there we go. Would you buy a building, specifically that building, just because you can finance it? And I've never had anybody say yes, so that's usually a good start to the presentation, because if they say yes, then I'm like, okay, we need some major perspective shifting here going on here. And it kind of becomes that dovetail into, this is what we're putting in front of a client. Their perspective about life insurance very often, because of what they've been trained to think through years of commission-based salespeople and slick marketing efforts by insurance companies with the greatest financial vehicles in the history of mankind, literally. And then all of these ways to promote those products to our affluent clients that just reinforce negative psychology from my perspective.
Can you zoom in a little bit so we can see the numbers?
No, I'm purposely, well, that's a joke, I like it. Maybe later. Is it, to your point, let's leave them unzoomed. Either way, is it an easy sell? The answer is no. If somebody were to tell me one word, economic word, a financial term that describes, in their mind's eye, the economic advantage of life insurance premium financing, does any word come to play?
Leverage.
Okay, somebody said leverage, any other words? Arbitrage, okay. 2 words I always get. Usually in a big crowd I hear leverage or arbitrage. And ultimately it starts to kind of set the stage, because are they the same thing? Is leverage the same as arbitrage? Are they synonyms? And that's where it kind of starts to get cloudy. Even in my head, initially when I throw around terms that I think I know from school or whatever, and I started to pick that apart in some of the early days relative to what I perceived that clients were thinking. Anybody a Jerry Maguire fan? The movie Jerry Maguire? The manuscript that got him fired. Anybody know what the name of it was? The things that people think but don't say. The things that people think but don't say. So how many times as humans are we on the other side of a table, and in the case of it's a CPA or an attorney, advocate of the client themselves, I can guess what I'm thinking. Two problems with that. A lot of times I'm wrong. And second part of that is if what they're thinking is negative or it's not in concert or it's not, come on in.
I just gotta be bigger.
Hi, Jeff Kesselman.
More.
Should we break for a second and let them say something? I'm fine.
John, could you have had the meeting a little further from the airport? I tried.
All right.
Go ahead, Steve.
Jeff Kesselman from Pacific Life. Everybody welcome. Right?
Our airport's not close to anything, I'll tell you right now.
No.
Yeah.
Kansas City Airport
Yeah.
meeting.
But you can't say anything, just, you have no reply.
Right, exactly. So as we're talking about, if the things that people think but don't say, if we're at the point of sale with a high net worth client, who we know is super smart, knows financial stuff in and out in their own mind's eye relative to what they're comfortable with, whether it's buying real estate, investing, running a business, what have you. And then they have thoughts that are going on in their head about life insurance that we're not getting on the table. And ultimately, the industry, with these great products, has done nothing but, from my perspective, because it's a matter of perspective, reinforce that by telling clients that they have to write checks for six-figure or larger premiums, right? To do things like pay the evil IRS, the necessary evil part, because they're going to take half your estate when you die. It's only good for survivors, right? And ultimately, all those things are kind of floating around the fact that it's life insurance, and it involves mortality. I don't like to think about dying. I don't think anybody does. I mean, we do, we all do, we contemplate it, but nobody enjoys it. It doesn't usually fuel a positive thought process. So ultimately, we got those four representations or thought processes going through the client's head. And when I first got in the business, I had to see a lot of people. We cold called on Thursday, 600 dials, hoped for 400 or 40 meetings, and 22 of them would actually let us in the door. 8 of them would say leave when we said it was about life insurance, and then we might get a client or two over the course of a year. We were beating our heads against the wall because this is what we were dealing with. Now, I want to stop there for a second because I have this slide somewhere, but I don't have it today. Everything that people know about life insurance, when I think about it myself, and my grandparents are worth $30 million, and the estate taxes are going to be 50% over some threshold, okay? Let's just say we've got a client fact pattern whose estate is $20 million, to make the math very easy, over whatever the threshold is at that time. So they have a $20 million taxable estate. How much life insurance should they buy in that scenario? Anybody got any numbers that jump out? It's a 50% estate tax rate. 10 million is a good answer, first answer out of the gates. Anything else? Usually, I'll kind of lead the charge here. Usually, when I start to get people thinking, right, because that's what we want thought process here. Well, how old are they? Oh, they're 60. Okay, well, they're going to live 20 years actuarially, so their $20 million taxable estate is going to be 40. So let's buy 20 if they can qualify for it. I had the smartest life insurance salesperson. That's how this person made their living. But he was really smart. He goes, well, I wouldn't buy any because we could, with 20 years, we could plan away everything with this effective estate planning, which is probably true. But the guy makes his living selling life insurance and just said the answer was 0. My answer is as much as they can get, as much as they can qualify for under underwriting constraints. Because when we look at life insurance from a different perspective, which is what I'm going to get into today, a different story starts to unfold. It's not the story of the evil IRS. It's not the story of the you have to do this. I mean, when my ex-wife tells me what I need to do, what does my brain do as soon as I hear that?
I don't want to.
No. Thank you. I just shut right down. No matter how logical it is or whatever she's telling me I need to do makes sense, I don't hear it. I literally don't hear it. So we're telling really smart people that they need to buy a bunch of life insurance for 6-figure checks because the evil IRS is going to take half of what's left when they die. It's just not that great of a story.
And that happens to be my actual wife, but for you, it's just your ex.
Well, since I don't have an actual one yet. But if you want to go there, before she was my ex, yeah. Let's just say any kind of spouse, current or otherwise. And we should be fair, spouse, not necessarily a wife, because they could,
Well,
wives
coming
could be
up
saying
with
the same
72
thing.
different variations.
We have a meeting right now at the tennis club saying, well, my husband tells me what I eat. Okay, moving on. Premium financing comes in, right? It's the holy grail. I mean, when I was in the 90s trying to get clients to write six-figure checks and beating my head against the wall, and sometimes I'd be successful and made a pretty good living doing it, but it was hard because of all the stuff we just touched on. Well, all of a sudden, life insurance premium finance comes on all the rage in the early 2000s. I joined Julian in 2002, I think it was. And ultimately, you think about it, it's potentially a cheaper way to fund a life insurance, right? I mean, if a premium check's $100,000, and they can fund the same death benefit for $3,000 in year one, interest payment on a $100,000 loan. Well, initially that sounds pretty attractive, right? Especially if it's framed that way by the salesperson. Hey, Mr. Client, I know you didn't want to pay that $100,000 awful high premium, but I wouldn't want to write that check either if I were you for the evil IRS because you're going to die someday and only benefit survivors. If I could get it to you for $3,000, would that make sense? And initially it does, right? But then you just start down that path to, I call it the three-walled sales canyon of premium finance, which is, if we don't deal with the underlying psychology, nothing's gonna change my mind. Like I have 6 daughters, okay? If God forbid, one of my daughters was gonna marry a guy that I just wasn't a fan of, right? And I didn't have the money to pay for the wedding. So in my head, this guy's gonna break her heart, they're gonna get divorced, this is not gonna work out, this is awful, and now I've gotta borrow money for the wedding. How happy am I going to be to stroke in my signature for the loan for the wedding? Not very happy. So when we start talking about negative things relative to the financing piece, all related to a thing that the client isn't convinced they want anyway, that they're thinking all this negativity about, right? We're just putting gas on the fire from a psychology perspective, because again, we haven't dealt with the underlying scenario. Would you sign the note? Would you pledge a personal guarantee? Would you post collateral for something that you weren't convinced you wanted to pay for anyway, but now somebody says you can get it for cheaper, but it comes with all this potential exposure? I saw a lot of cases opened up in the early 2000s where, I mean, hundreds of them, right? We were just seeing just come through the door, just boom, 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 and very few of them would close again. And some of this, took me some time to figure out when I would talk to people and just kind of think about it and go, well, wait a minute, I think we're missing a big thing here. And the reality is that at the end of the day, we've got some underlying psychology there. So I want to share a quick little story. Every client that you'll talk to, every prospect that you'll talk to, every advisor that you'll speak with about life insurance premium financing will understand this story. And I'm going to cut to the end, just in the interest of time, because I'm going to go through it quick. We have the same story, only better, with the asset called life insurance. It goes like this. The clients, high net worth clients, looking out his window, he or she, there's $1 million building. This is the old days before real estate boom, or bubble, should I say, maybe. $1 million sales price, $60,000 annual cash flow, a nice commercial piece of property. And they've been looking at it, it's like staring at that building for the last 10 years. If that thing ever goes up for sale, I'm gonna buy it. There's just something about it I like. Realtor comes in and says, hey, Mr. Client, I know you've been looking at that building. I've got a crystal ball, and it's gonna appreciate it 7% per year for 20 years. Take it to the bank, crystal ball's never wrong, okay? Positive cash flow, guaranteed appreciation in 20 years. Would that client potentially consider acquiring that asset? Absolutely, right? Never had anybody say no. By the way, what would they do before they actually wrote a check for $1 million? Would they just write the check on the spot? No, probably what? Get an inspection maybe? Get an appraisal, make sure it's worth what they might think it is, and that the listing price is in the ballpark, etc. So they do a little due diligence. They actually think rationally and logically about the asset that they're interested in acquiring. Okay, big point there. Ultimately, 20 years down the road, the projection is rule of 72 doubles twice. Got $1 million asset, now it's worth $4 million, generating inflation-adjusted $250,000 in cash flow. Pretty good story. Pretty good story. I'd pull the trigger on that all day long if I was a high net worth client. Right before that client writes the check for $1 million, because that's what he's got to invest, $1 million. Banker comes in and says, well, wait a minute. You wanna buy a building for $1 million, you got a great guaranteed appreciation. I've got 4% money right now that I could get you fixed for 20 years, and your asset's growing at 7%, okay? Wouldn't it make sense to start looking at financing that? And would most clients consider financing that building, putting 20% down? And what's that, what do we call that? Borrow at 4, reinvest at 7. What's that called? Arbitrage, exactly right. Okay, there's that spread between the underlying cost of capital and the guaranteed crystal ball appreciation rate. Okay, so that makes sense. And the client says, well, yeah, I ought to do that. And now I got $800,000 left of my $1 million to do something with. Put in a CD, whatever. Well, that's a good question, whatever. Because the realtor comes back and we just talked about that being arbitrage. Realtor comes back in the story and says, wait a minute, I knew you had $1 million to invest. I had a crystal ball, assets growing at 7%, you got 4% money, I get it. Didn't know your banker was gonna come into the mix, that's good news, unexpected. I got 4 more buildings just like that one. Got 4 more buildings, carbon copy, same crystal ball, 7% appreciation rate. You can get them all for $1 million. Okay, so now we buy $5 million of underlying real estate value, all with the same economic characteristics. Okay, what's that term? What do we call that? Leverage. Acquiring more of the same underlying asset with the same amount of committed capital. Okay? Both of these are going on with life insurance premium finance. The market tends to only talk about arbitrage. And there's a couple different arbitrages that they focus on. The easy one, which is the back yourself further into a corner, potentially. The crediting rate of the policy and the borrowing rate. Okay? There's probably, with index products, I especially when we talk about some of the stuff like a PDX product is done with some of the rider features that are built into it and multipliers, and et cetera, all these cool, really cool things. These are geniusly attractive characteristics for a financial vehicle. Complicated, but genius. And ultimately probably will deliver significant arbitrage over a long period of time. Number one, not guaranteed. Number two, in today's world, what's our issue now? Hard to illustrate it, right? We're kind of handcuffed with how much we can illustrate what back-tested wise is some pretty attractive arbitrage opportunity. It's also missing part of the story, a big part of the story. Anybody drive a Tesla? I was thinking about this morning. We got a Tesla driver in the back. So those batteries are pretty bad. Good, right? Cool, right?
Yeah, I got a Plaid and it's nuts.
So can you imagine when I'm talking to somebody about the battery in your Tesla and forgetting to talk about the actual engine, the thing that is really super cool? And that's kind of what we do when we talk about arbitrage and premium finance and forget to talk about the leverage aspect of it if it's designed right. So we're talking about the gas instead of the fire. And I think we should be talking a lot more about both of them, but we absolutely have to be talking about leverage. So we know we've got leverage here, and we talked about the economic characteristics there. 20-year projection, same amount of committed capital, $1 million. Crystal ball comes true. Now we've got $20 million of real estate generating over $1 million of cash flow, all with the same investment. Okay, that was not fueled by 4% arbitrage opportunity. Most of that was fueled by acquiring more of the same underlying asset for the same amount of committed capital. What happens in the future? Well, I mean, flexibility, right? We've got real estate and we got some options. We can sell it all in a liquidity event, okay? Get rid of it all. 20 million bucks. It's about a 17% internal rate of return on a 7% appreciating asset, okay? Again, a 3% arbitrage piece of the puzzle did not generate 17% rate of return on capital. The leverage was the big bump there, the big boost there. Okay, we can retain it for income. We just established we went from 250,000 of cash flow to over $1 million, acquiring the same asset with the same amount of capital using the leverage option. Okay, so that's a huge increase in net. Or what about a little bit of both? What about sell 2 of the buildings? Take the proceeds from 2 buildings, pay off whatever debt is left, get our original $1 million investment back, so now we're playing with house money kind of thing. So we're taking some off the table, and we still have 3 buildings generating positive cash flow. I frame it that way because those are basically the 3 outcomes that we illustrate with a life insurance strategy. We talk about death benefit, We talk about overfunded life insurance just generating supplemental retirement. We talk about premium financing, overfunded life insurance, take cash value withdrawals in a few years, or 15, 10, whatever years, pay off the lender, take them out of the mix, whatever's left over, solve for retirement cash flow. I'll tell you, economically, that's the least attractive of the three, and it's the only one we illustrate. Doesn't mean we shouldn't do it or won't do it when the time comes. I don't know what the crystal ball is gonna look like with our clients. If it makes sense to unwind or to withdraw some of the cash values and pay off the lender, it'll make sense. It either will or it won't. But we're just, that's all we really illustrate, because again, we're trying to make it look cheap, make it look like the client's got as little skin in the game as needed to entice them to buy this god-awful thing called life insurance, when it's really one of the greatest financial vehicles they can get if we can just reframe the story. Okay? So, it's a matter of perspective. Would you finance that building just because you could, or would you buy that building just because you can finance it? No. Would you buy that building if you could finance it? You start looking at it a lot differently. So the question is, how do we get our clients who are looking at it like this to look at it like that? Where'd that mouse go? Oh. I pushed the mouse button. Thank you. Yeah, I thought you were messing with me. Mr. Tech guy. That's right. Okay, so how do we do that? I'm starting to look at myself in this re-envisioned world relative to life insurance and financing of life insurance as you guys ever heard the term influencer in like internet marketing? I don't even know what it meant, but I kind of looked it up. And I get it now. You know, people have, if they can gain an audience and offer some perspective that's different, or might appeal to a person's way of thinking, they can influence them. They can influence the way they perceive something. I'm thinking of more of as a shifter. With what I see going on in the world right now, and again, this is just my brain,